Welcome everyone to a new Artisan stock picking challenge. It's a pleasure to welcome you all here in this beautiful new building. We cannot get enough of it. And this is our first in-person event, I believe. We're incredibly, we're delighted to be meeting again in person and, and have you all again physically here. I want to thank, of course, Artisan for putting all this together, Mary for organizing everything, all of you for participating, and Paul, the floor is yours, and thank you so much, as always.
You're welcome. You're welcome. Thank you. Thank you. Yeah, this is. I came up to the new building 4 weeks ago. I've been sitting in Michael Gatto's class on Thursday nights, which is a treat, actually. He is fantastic. So I've got to see the building. I started at the top, walked down, and saw everything, and I saw this before I realized. So we're in the Bruce Greenwald official auditorium. We'll talk a little bit about Bruce. I just want to give you a little history on how we got here, because I think it's cool. And the judges sort of think it's cool, but how we got here is crazy. All right, so you're going to see some numbers that don't add up. All right, so first number, this is the third annual Artisan Partners International Stock Pitch Challenge. But this is the 12th event. And it's the 4th event sponsored by Dave Samra, who is Artisan Partner. So go figure how all these numbers add up. It's held in honor of both Alex Porter and Moon Lee. We'll talk about them in a moment. Technically, the winner wins the Sonkin Prize, which is named after Paul Sonkin. We'll explain that. And then here's the past winners for the last 4 years that Dave's been involved. And you can see the name. So it's really a pretty cool event. All right. But to understand how we got here, you sort of have to go back in time. And I'm going to talk about what I think are the 4 most important people in the history of value investing and how we got here. In fact, I'm in theory writing a history of value investing book called The Three Gods. But it dawned on me there are actually 4 of them. So we have to figure out how to make that title work. All right, let's talk about it. So Ben Graham graduates in 1914. He's the second in his class. He's 19 years old. And he's offered on graduation to enter the PhD program in philosophy, math, and literature, which, so you can see already, brilliant. Oh, and by the way, a tuition-free scholarship to the law school. His family's poor because his father had died prematurely, and he decides to go to Wall Street. He clearly has a very analytical mind. He is very successful in the first 15 years of his career, and then 1929 comes along and obviously wipes him out. In 1927, he decides he wants to write a book on security analysis. There wasn't anything out there, but he thought it would be best if he could organize his thought. So he comes back to the Columbia College, which is where he graduated. He was working on Wall Street, although he lived even further north than we are now. And most of the classes were taught downtown. NYU Business School was downtown at the time. My favorite joke is it was a trade school. That's where you went and learned accounting and business management, and it's still a trade school. So, that's the NYU joke. So he comes up here and he starts teaching an extension course on Monday nights. And the first year, 1927, right, middle of the bull market, he has 200 students in the class. He then teaches in 28, and he continues to teach. And he finally teaches until 1956. He did take 4 years off where he did not teach during World War II. And he publishes Security Analysis, which is the result of that course with David Dodd in 1934. And that's certainly the Bible of the way we think about the father of security analysis, goes way back. And then, of course, greatly influenced people like Warren Buffett, Robert Heilbrunn, which is the center is named after Robert Heilbrunn, Bill Ruane, that goes on and does Tweety Brown, Irving Kahn, who just passed away a couple of years ago at the age of 101, Sandy Gottesman, who did Manhattan Partners, and Walter Schloss, who very famous investor. Obviously, Buffett being the most important. He retires in 56 from the school and from New York. He lives half-time in La Jolla, California, and in France. It kind of gives up his interest in investing. David Dodd is a young professor. He has a master's degree at the time. And when Graham starts to teach, he asks to have somebody come and transcribe his notes. And they assign David Dodd to help him out. And David's job was really to organize the notes, fact-check everything, and then do the security analysis behind Graham's cases. And then they publish, obviously, together in 34. He retired after 40 years in 1961. Interestingly, he was the dean of the business school, or head of admissions of business school when a guy named Warren Buffett applied to the business school. And when he found out he was being interviewed by David Dodd, his line was, he had read Graham and Dodd. He loved the book, and he'd also read The Intelligent Investor, which had just been published. And he said to Dodd, he said, I thought you guys were dead, which is apparently got him into the business school anyway. Thought that was great, which is very good. So Graham retires in 56, and a guy named Roger Murray takes over. Roger Murray had spent his whole career as an investor at Bankers Trust. Paul Sonkin, who is a judge, although he's not on Zoom, and my co-author with Pitch the Perfect, we're about to publish a book, a biography of Roger Murray. It should be out later this year, which we're pretty excited about. So Roger Murray starts teaching in 56, takes over for Graham, and he teaches until 1977. And he had a couple of students which you might recognize the name of: Mario Gabelli, Leon Cooperman. Leon Cooperman, there's an auditorium on the main floor named after him. The room down the hall is named after Regina and Mario Gabelli, very important. And Art Sandberg, who passed away last year, was a very, very successful growth investor, interestingly enough. And then Chuck Royce was, you know, about the Royce funds. In 1993, after he retired in 77, in 1993, Mario Gabelli was very concerned. Roger Murray was 81. He was very concerned that Roger would die without all of that knowledge being captured. So GAMCO, which is the Gabelli Management Fund, sponsored 4 lectures here in New York on Fridays, 4 sequential Fridays in February into March of 1993, where he had Roger speak, and that for 90 minutes each week with basically no notes. It was saved on a DVD. If you're interested, we can get you a copy of the DVD. We did transcribe it for the book, so we'll have the whole transcript in the book. And that was a big deal because Mario got the dean at the time, Meyer Felberg, to come to the lectures. This was a big deal. And Meyer Felberg got a young, recently tenured professor named Bruce Greenwald to attend the lectures with him. This is Bruce's room, named after Bruce, which was pretty cool. Prior to being involved in this event, I didn't know the other part of the story, which was that James Pan, David Samra, and Jason Leonard were also at those lectures. And in fact, they were MBAs. They were about to graduate. They were in their seniors that fall, that spring term of their second year of their MBA. Very interested in value investing and very frustrated with the school because at that point, the only thing that the school taught, many business schools taught, was efficient market theory, CAPM, and all of that nonsense that they still teach. Weird. You should petition for your money back. And they were frustrated, but they created a subculture among the students for value investing, just this group. And they would bring speakers, and they had stock pitching competitions, and they wrote articles in the newspaper, the student newspaper. They really kept it alive. Very excited to go to the lectures. And at the lectures, they basically said to Bruce and Mario, you know, how can you not offer this at this school? It's this huge legacy, as you just saw. And it's fabulous. We love it. You guys loved it. Why wouldn't we do it? And there was a lot going on. Alumni were starting to get interested. There was some funds coming in to try to do it. The students were pushing at the same time, and all kind of came together. Bruce attended the lectures, and walked away and said, we've got to reinstate this back into the school. So we start to see that connection. All right. The third most important person, or the fourth technically, is Bruce. And in 93, he listened to the lectures in February, and then he convinced Roger Murray to come back to the classroom for the last time. And they co-taught a class in the fall of 93, which was the first time value investing had been taught since 77 at the school. That went on to be a value investing course that then went on to which Professor Cantos teaches now. So you can see how that all was doing. And that came together. And then Bruce, you're very unfortunate you didn't have a chance to take courses from Bruce. He's the most dynamic professor I've ever had the opportunity to sit in the classroom. Sorry, Tano, but I think you would probably agree.
I agree.
He is bombastic and brilliant and funny and had even a more foul mouth than me, which is really shocking for those of you who sat in my class. I was listening to Bruce, and that's why I realized I could use the F and not get fired. So I was like, but he's tenured. I didn't realize that was part of it. And then Bruce, unfortunately, did retire in 2018 after 25 years of teaching value investing. All right, here is, I've been thinking about this by writing this book on Roger Murray, is what was the contribution that these gentlemen had to our understanding? And two big insights Paul and I have been talking about. First really is Graham and Dodd, and when they came along, it was the first formal approach to value investing, to investing. And it really, Graham's insight, which is brilliant, now we take it somewhat for granted, but it was brilliant at the time, that price and value could deviate. You could have this fundamental value, and then price that's driven by investor expectations, the market and things like that could deviate. And if you were keen enough to understand value, you could take advantage of the volatility of that price. Because when price was less than value, that created the opportunity. And he was the first to really formally talk about that. And he coincided, the publication of the book, 1934, coincides with the Securities Act of 1934, which required companies to disclose information. So they just happened to be coincidental together. Graham was also a practitioner, and that was important. So he was bringing to the classroom every day, or at least with weekly class, things that he was really learning and struggling with and trying to figure out. And I think that was the value. I think that's one of the great values of the Columbia Business School is, where theory meets practice, is just this so close connection between the academics and the practitioner. And I think that really, in investing, really started with Graham, and he continued it. All right, Murray comes along, and Murray had grown up also as an investor in Bankers Trust, an institutional money manager. And what he really developed was this idea of institutionalization of investing, or what I try to think of it as rigor, that discipline of doing the work. And he was very big on making sure you did all of the financial analysis on the company you were looking at, and not just this year or last year, but you would go back and look at companies through cycles, through competitive changes, through product changes. And he said you had to go look at that whole history, and you had to boil that all down. Leon Cooperman tells a story that Leon, turned in a paper that had, it was essentially 25 ratios on 20 companies, so 500 ratios, and Roger Murray picked out one where he had transposed the digits, and he sent him a note. And Leon, 50 years later, tells that story. That's how keen Roger Murray was on all of that, which is very important. I think Bruce's real contribution was this idea of earnings power. What is earnings power value? What does that really mean? And it's driven by the cash flow that the company's generated. What portion of that cash flow is driven by a competitive advantage or excess returns? Because if those excess returns if that competitive advantage is not sustainable, those excess returns will go away. And if they will go away, that will erode the fundamental earnings power value. And oh, by the way, which was, for me, was really, when I first heard that, I had the opportunity to sit in Bruce's class 3 semesters, not 3 lectures, 3 semesters. I kept coming back. I mean, he was truly a brilliant lecturer and a brilliant intellectual. What I really captured was this idea that growth has no value if you don't have a competitive advantage. So now, not only do we figure out really the true value of earnings power is driven by a layer of excess returns, but then growth only has value if you have that layer. And Bruce, really fabulous. For me, anyways, was brilliant that way. All right, the challenge we now face is growth. And I think what's very important is if you think about Graham being a practitioner, he came to the classroom and to his writing and was talking about what he was doing, what other investors were doing. Roger Murray did exactly the same thing. He just brought with him that institutionalization, that discipline of being a professional investor. What Bruce did is he was explaining what Buffett and Munger were doing when it came to growth and this idea of sustainable competitive advantage and that franchise value. All right, so the challenge for all of us now is growth. And if you think about what's gone on, is value investors have turned to growth over the last decade. Partially they had to, but I think they were intrigued by it. Certainly one of the largest equity positions that Seth Klarman has is Google. And I think if we think about it traditionally in the Graham and Dodd, maybe Murray camp, you'd never get to Google, and yet Seth Klarman, one of the great value investors, feels that is undervalued that way. So we have to be able to explain growth. Paul and I published our book 4.5 years ago, and afterwards we decided that we wanted to take on this idea of growth. I had the opportunity to co-author a book 100 years ago called The Gorilla Game, which was a growth investing book. And it dawned on me after we got Pitch the Perfect that the two books were talking about the exact same elephant. They probably were connected. And I spent the next year and a half trying to figure it out. And 2 years ago, I finally one day, just sometimes you figure this out, I had been an idiot for a long time because I was just in my own way, and I finally got the blockage out of the way, and it came together. And I'm going to show you some of the charts we're working on. He and I are, after we do Murray, we're writing a book called The Value of Growth, and we're going to use some of it, see if we can explain some of this to the world. All right, so there's Apple. Everybody knows Apple. You use the product every day. It's been a monster stock. It's the largest market cap in the market. And that's their revenues. So certainly have grown a lot more recently. Don't be confused. The last bar is actually LTM because they have a September fiscal year. So that's just December. So we've added one more quarter to it. So it's slightly more. But I wanted to capture the numbers. I mean, certainly impressive growth by all measures. Here's their enterprise value. And you can see that the enterprise value has expanded. Visually, it looks like it's expanded much more than revenues have. Partially driven by profits, fine. So here's something that, this is a new chart, many of you have not seen. So this is the market implied value of growth in Apple over time. This is what investors are paying for, and they believe the growth will materialize, the growth in cash flow. This is the market implied value of growth in dollar terms, and then there's the market implied value of growth as a percentage of the enterprise value. And you can see that it's a brand new company from where it was. It spent a lot of time not very high, and then all of a sudden much higher. Interestingly, this is when Buffett bought this stock. So out of the valuation, you're only paying 6% for growth, you're paying 94% for the current value. His bet was, it's just the duration of cash flows would continue. That was the bet. He wasn't paying anything for growth. He thought this was the best thing that happened. If you use a little bit higher discount rate, the growth even actually goes away. So that's sort of interesting in my mind. All right, now here's the market value growth for the S&P 500. Another chart that I've never seen anybody try to do. And you can see that last year we got a little bit carried away, all-time high. We're back to within that 5 and 10 year range, interestingly. A lot of people can't decide what's going to go on the market. But if you look at it from this perspective, if you think that the economy is generally going to grow the same, we're back to a range where it may not be overvalued, which I think is kind of interesting. So there's the S&P 500 against Apple. So Apple trades at a premium to the S&P 500. And you have to ask yourself, will Apple over the next 5 or 7 or 10 years grow faster than the economy? And that's an interesting bet because I don't know if you know this, but Apple produces one product. It's called a cell phone. And so the challenge will be, can they continue to grow cell phones? Now, we've had this burst of activity in the rest of their product line. In fact, there's their product line. You see a big jump in 2001. But if we look at product year-over-year growth, we see this thing which we might think of as the COVID spike. Right? I certainly, when we got locked down on March 13th, 2 years ago, we're almost about the double anniversary, I went out and bought a new Mac and new headphones and new computers and new iPads because it looked like we were going to be in for a while. And I think a lot of people did. But the question is the growth rate going to be more like what it was pre-COVID or post-COVID? But you're paying a lot. You're paying more for growth now than you ever have. So we think that that's kind of interesting. All right, so back to the current topic at hand. Bruce leaves the lecture and he says, this is a quote in the book, but it's a quote that was also in Graham and Doddsville, is where we got it. Like generations of investors who preceded me, I was struck by the compelling logic of Graham's approach. As a consequence of those lectures in 1993, I dragooned Roger Murray into joining me in offering a revised version of the value course. And so this was the course, Fundamentals of Investing. I think, James, you sat through that class. Did you sit through the class in the fall?
I would sneak into the class. I had graduated in June.
Yeah, you graduated in June.
Jason and I would sneak back. He went to San
Yeah,
Francisco.
you had come to San Francisco, right?
Right. Jason and I would sneak back.
Yeah. So
I would get his notes, which were incomplete.
yeah.
So, messed up my first few years.
So the first 4 weeks where they were talking about, balance sheets and income statements and stuff. But then the next 8 weeks, I think it was, Buffett spoke, Gabelli spoke, Chuck Rose spoke, Seth spoke, Michael Price, Robert Bruce, Walter Schloss, and Andy Weiss came to speak, which I'm going to give some credit to both Dave, Jason, and I guess it's technically more than both, and Jason, because they had already started that tradition of having great investors come to speak. And so this made it formal. And then today, the course you guys can take, Legends, is essentially direct relation. It directly goes back to this, which I think is pretty amazing. The Heilbronn Center, which obviously Meredith and Tano run, has a long history coming out. They we convinced them to take over the Artisan Challenge a couple of years ago, so now it's officially part of that, which we think is just fantastic to be part of the formal program. This year, what we do is it's essentially an extension of security, AVI, yeah, applied or advanced? Applied value investing. 9 recommendations were submitted. We picked the top 4, which you're going to see in a few minutes. It is sponsored by Dave Sammer, Artisan, in honor of Alex Porter and Sonka. I'm just going to give you a couple of, here's that long history. So it was the Moonlee Prize for a few years. It was the Amici Capital Prize for a few
I
years.
just want to call it that Michael is in the audience. He won the Moonlee Prize.
Oh, you did? Congratulations. Oh, fabulous. So, look,
2012.
even more history.
Yeah, he got a job.
Your name's in lights, right? Took a long time to piece this together. Then we sort of ran this little ragtag thing with Justin and then Tyler won. And then the last 2, and we'll see who wins tonight. It's pretty cool. So that's where all the numbers come from. And I could go into a lot of detail. The only thing I'm going to say about Alex Porter is he's a gentleman's gentleman. There was a time on Wall Street where actually people were gentlemen. I started in the business a long time ago, and they were actually very honorable. He was a great guy. Jeff Holm, who's here tonight, worked for him and can attest that he was one of the great guys. His first job on Wall Street is he worked for free for Jennison for the Greek guy. What was his name? Who ran African thing in a minute. And he worked for free. And then he worked for A.W. Jones, which was the first modern day hedge fund. Really, Graham Partners was the first hedge fund. And then he went and started his own firm, $360,000 with 3 friends. That's where he got the name Amici. Great guy. Moon Lee worked for him. Moon Lee was also just a fantastic, I didn't know him. I think, Jeff, you worked with Moon, right? Just one of these great guys, died prematurely of cancer in his mid-30s. But very, very generous, very thoughtful, very passionate about value investing. And Alex really wanted to honor Moon Lee because of his passion. So they created the Moon Lee Amici Capital Prize at Columbia Business School. That's how it all got started in the past. Jeff Holm, who's one of our judges, got involved because of his relationship with Alex and indirectly with Moon Lee, and he helped this thing keep going. He was very involved in it. In 2017, I met him on a very wintry day in front of Warren Hall, where I thought I was going to be a judge, but I was the only one who thought that. And so I showed up, and that very nice person at the reception said, "Can I help you?" I said, "Yeah, I'm Paul Johnson." She's like, "Who cares?" And I said, "I tend to agree with you." But I said, "I'm a judge." She said, "I don't think so." Jeff walks in a couple minutes later. I meet Jeff for the first time, and he's like, "No." And so I was like, "I'll go home." But it ends up that James Pan, who's very good friends with Jeff, had suggested, you guys have worked together, right? Had suggested that I could be a judge because James Pan had sat in on my class when I started teaching literally 31 years ago. It's true. 31 years this June. He sat in my class, and we stayed in touch a little bit.
One of the best lectures I ever attended.
He said to me, we ran into each other a couple of years ago at the SEMA conference at the breakfast, and he came up and he introduced. He said, "You might not remember me," and I don't even remember anybody. He said, "I sat in your class. That was so great." He said, "Actually, it was the best lecture I've ever had." And I was like, "Wow, that's very flattering." And then he said, "No, I use it a lot. I made a lot of money." And I'm thinking, how about a little VIG, right? How about a little, like a little kickback? I mean, if it was so good, I didn't make any money when you sat in on my class.
Well, I palmed it off of him, so he made a lot more money.
Oh, that's good. Good enough.
Second derivative.
The most important point I want to say about Jeff, the most important is he single-handedly kept this thing alive in 17, right? He was the sole sponsor. He wrote the check to pay for everything and the prize money out of his own pocket. But if he hadn't done that, we wouldn't be here tonight. So that is really important. So you can see how this all starts to come together. That's why I love this event. Because this is the history of Columbia Business School in a single event. Paul Sonkin is my partner in crime, who is supposed to be a judge tonight. Graduated, he took my class, graduated in 94. He went on to be my TA for a year, but he started the AVI program in 1998, and it came out of his class. So AVI, which is the feeder to this, is really started by Paul, which I love. And then he donated some money to CBS, and it sat dormant for a long time, and it, not a lot of money, but that technically, some of that money is supposed to go to the event tonight, but that's your job, not mine. Dave Samra, we talked a little bit about him, graduated in 93 with James and Jason. Very, very passionate guy investor, and he's been wildly successful as an investor. If you're interested in big cap value and you really want to work hard, you should contact Dave. You're always looking for support.
He hired a past winner.
And he hired a past winner, right?
Tyler Red.
Oh, yeah, Tyler Red. Yeah. So if you do a really good job tonight and you impress him, but Dave is really going to save you because once he got involved, he was close friends with James. James obviously connected through Jeff, Jeff through Alex, and Dave has really been the sponsor. He's kept this going, and we can't thank him enough. The prize money comes from him and the passion and all of that, which I think is great. James Pan, great investor. He's this is what you hope for in life is he retired at a very young age just to manage his own money. Not bad. Great individual investor. Very impressive. Terrific. Work for some great investors. And so if you can get a job working for a great investor, it's just priceless. I always say you should pay them. They shouldn't pay you. Don't argue about the salary. Just make sure you get the job. You work with Jeff Hallis, which he's
Had a meeting with him today.
that guy is brilliant. And he started his own fund in '98. And then we talked already a little bit about this, so we'll go through this, but here's some of the people that James, David, and Jason had. Mario came, Liz Bramwell, Ann Cooperman, Chuck Royce, Jimmy Rogers, all came to speak before we started this. And then they pushed hard to get there. And then they attended the Murray Lecture, which we talked about. All right, last year's winner was DXC Technology. It was $26 on the day of the challenge. Hit $66 in August. He had a $66 price target. Hit $44 in August. I'm sure he would have taken the trade off at that point. And then it's $35-ish today, and there's a stock chart. All right, I've taken up a lot of time, but I think it's really cool, and I think every generation that comes through should learn the history and how we got here. All right, so with that, I am done. Meredith, I think it's your up next. All right.
Window. So it's gonna be 10 minutes of pitching and then 10 minutes of Q&A. Julia is keeping the time and she'll give you a 1 minute.
So good evening, everyone. I'm Wenbo Zhao, and today I'm going to pitch a long position in Artisan Transmission with a 4-year price target of $71 with 22% margin of safety and 70% IRR. Okay, so let me put my thesis in one sentence. Artisan is a great company at a cheap price as electrification is overblown. So first, Artisan has defendable competitive advantage in its core transmission business. It is a premium brand with 75% market share in North America with strong pricing power. And the second thing is that it's now a cheap buy with current valuation barely capture any future growth. The third thing is that the impacts from electrifications are overblown. Artisan has over 70 years of history in providing transmissions, and it is the world's largest manufacturer of fully automatic transmissions, or we call it AT, for medium and heavy-duty commercial vehicles and defense vehicles. Nearly half of its revenue comes from on-highway markets in North America, and it also sells to global on-highway and off-highway markets, like off-highway vehicles in like excavators, like backhoe tractors, and it also sells to like defense market and service parts and aftermarkets. Artisan currently trades at $39. That is 10 times EV over EBIT. Following COVID-19, its price faces pressures from cyclical trough in 2020 and also supply chain issues in 2021 in the auto industry. So I also want to emphasize that Artisan has a phenomenal return on capital because of its pricing power. And so Allison is not a commodity business one might imagine when they think of a auto part company. Like automatic transmission is highly engineered. It requires advanced manufacturing process and employs complex software algorithms for transmission controls to maximize user performance. The first part of this thesis is that Artisan is a dominant player in AT for commercial vehicles. Let's look at the pie chart on the left. Artisan has like 60% market share globally. And to be more specific, it actually supplies nearly all of the automatic transmissions in North America for commercial vehicles, and especially in vocations where there's a lot of like stop and start activities. AT also faces more competition from manual and automated manual transmissions in Europe and Asia. But in North America, from the left bottom graph, we can see that Artisan's AT is the de facto standard, and it has like 75% share in its core use cases. The second thing about this thesis point is that Artisan's strong pricing power is rooted in its customer captivity. Fleets are willing to pay like $3,000 to $11,000 more than a manual transmission for Artisan's automatic transmission because it can pay back in 2 to 3 years and with better fuel efficiency and reduced clutch maintenance and downtime and higher residual value. And also, Artisan is comparing to other automatic transmissions, Artisan can charge like 30% more in price, and it is because it is a very highly recognized premium brand, and it's often specified by end customers or like those fleets. So it's common to see that commercial vehicle makers display Artisan transmission's name prominently along with the engine manufacturers in their marketing materials or on the body of the vehicle. And the third point of this thesis is that such customer captivity is sustainable. Like nearly all of Artisan's transmissions sold in North America are under 3 to 5 year agreements that include 1 to 2% annual price increase and the joint marketing efforts and commodity pass-through provisions. Going through the long and complicated calibration process at those OEMs and also with the benefit from like easy driving experience, especially in the face of driver shortage in North America, Artisan is able to retain the long-term relationship with both OEMs and also fleets. And Artisan has been a sustainable leader in its core markets, especially in Class 8 straight and like cement trucks, dump trucks, and fire trucks, and also Class 6 to 7 trucks like beverage trucks, street sweepers, and etc. And these two parts together make up like 35% of its like total revenue. Its competitive advantage in customer capability and economies of scale leads to an EBITDA margin above 30%, while like most of its competitors have like single-digit to mid-teen EBITDA margin. My second thesis is that current price is too cheap to reflect any future growth. The truck industry is cyclical, with like around 4-year cycle period, and the last cycle is like 2015 to 2019. If we value Artisan based on its historical performance of last cycle, and we can see that the current stock price of $39 fails to capture any growth potential. So where the growth is going to be coming from, I think there's going to be two sources. One is that the truck industry in the long run will continue to grow with the economy, despite of like cyclicality. Another source of growth is that, as I mentioned, they have like this annual price increase contracted in their long-term agreements. So therefore, I think the current price fails to take those potentials into consideration. And then you might ask like why current valuation is so cheap. I believe the market has overblown electrification impact on Artisan, and this is my biggest variant view from the market. It is true that electric vehicles will not need the complex transmission we used to have, and as Artisan starts to move towards electric powertrains like e-axles, its current high margin is not likely to be sustainable because this market is like relatively new with many more competitors. like since its current price captures like no future growth, we need to see like we need to look into like whether this impact from electrifications is going to lead to a diminishing AT business or their like traditional business when we're evaluating its current valuation. And based on my calculation, my answer is that the market has overblown on these impacts. The first point is that EV penetration in trucks would take like a longer progress than passenger cars because the use cases are much more complicated, and the end customers and fleets care more about economics. So the challenge, so it can be like very challenging considering the electrification if you consider the power density and life cycle and weight of a battery. And many estimate that the penetration will be like 10 to 15% in medium and heavy duty truck by 2030. And in my base case, I think the total I think the total truck industry will continue to grow with the economy at 3%. And even if EV penetration will be like 13% by 2027, we're still able to see a positive growth in the traditional ICE trucks in the next at least 5 years. And the second point I think that's missed by the market is that although the margin might be much lower for Artisan to provide electric solutions, the content value is actually 3 to 10 times of its conventional automatic transmissions, which is enough to partially offset the margin headwinds. So if we look at the bottom right table, comparing the case without EV penetration, you will see that a 13% penetration by 2027 will only bring down the EBIT CAGR from 2.6% to 2.2%. So in short, even when we factor in all those downside impacts from electrification, it is very unlikely to see a diminishing business or like a no growth scenario for Artisan, thanks to the growing truck industry and the slow EV penetration as well as like higher content value of electric solutions. So if you're interested, I'm happy to explain my calculation in more details in Q&A. And I used EV over EBIT for valuation. It has been trading at 12.5 times in the last cycle, and recently dropped to 10 times due to a cyclical trough and also increasing market concerns around electrification impact. I used 10 times for valuation, and I guess my 2025 price target of $71 with 22% margin of safety and 70% IRR. For risk, I mainly see two sources. One is on their conventional AT business. Its European competitor ZF is building a manufacturing facility in North America to produce automatic transmission for commercial vehicles, and will come into volume production in 2023. So it remains to be seen like how it will impact Artisan's market share. But ZF has been competing with Artisan more in buses, and it used to have like less exposure in Artisan's strongest class 8 straight and class 6 to 7 market. And another risk will be coming from electrification. If the electrification in trucks penetrates faster than I expected, at some point it will like eventually diminish the ICE truck growth. And since there are many uncertainties around the end game of EXL market, like increasing competitors, we're seeing like Dana and Marita.
You're over time. I'm sorry, but significantly over time.
Oh, sorry.
No worries.
Maybe
I'm gonna cut you there.
Yeah, that's fine because I basically talked through everything I need to cover. Yeah.
So, because some of the judges are on Zoom, we'll start with questions on Zoom, and then we'll turn it over to the judges in the audience. So, Jason, Carl, if you guys have questions, go ahead, and then we'll move to the live folks next.
Yeah, I guess a question that I had, partially you were referring to on the electrification just on economics. Do you think that some people like school buses and school districts might move even faster for non-economic reasons, for either, to be green or for political reasons, and maybe some companies, like Amazon or Target might do the same thing, where they might move faster than they would have just on pure economics, really to help their ESG measures?
I think although I said like in my base case I use like 13 penetration rate until 2027, but actually I'm like assigning like different penetration rates to different segments. As you mentioned, like school bus, I was assuming that the penetration rate is going to be 25% by 2027. But like I think for its major revenue source, as I said, class 8 straight trucks and class 6 to 7, who like these two together makes up their like nearly 40% of their revenue. These markets are like more difficult to be penetrated by EVs. So I think that's where like that's why like the total like the weighted average penetration of like 13% is like is not like very they're not like underestimates the trends in like ESG concerns.
I have a question.
Sorry.
First of all, I think it's a terrific pitch. I think but that penetration increases more than your anticipation. Can you talk about Allison's relevance in more EV-dominated worlds?
Sorry. You're saying like how like the more EV dominated growth is going to impact Allison's growth, right?
Is there a way to think about Allison as relevant as EV growth? Is there anything in more value per car that exists, or anything in electric vehicles that Allison would have a play on?
Yeah, so right now they are like moving towards electric solutions. They are like their e-axle are being like validated by many OEMs in North America and Europe and Asia. But actually, I did one. I think I did for electrification. Let me show you this. I think there are 4 key assumptions when we are looking at the electrification's impact on Allison's business. It's the penetration and the market share, and also the revenue per unit, as well as the gross margin of this new business. In my base case for penetration, as I said, I just use 13% by 2027. And because based on my study of the competitive landscape of this new business, I think it's probably going to be a commodity business in the future. So I like conservatively assume that Allison is only going to take like 10% of the market share, and like and the gross margin is roughly 20%, like most other auto parts suppliers. And from this case, we can and I just did a sensitivity analysis on how this is going to impact their EBIT CAGR on this from these 4 key assumptions. And you will see that the only most important assumption is actually EV penetration. Like, as I said, the current valuation fails to capture any EBIT growth in the future. So as long as we can see a positive growth in EBIT, that means like now the price is too low. So you will see that only when like the EV penetration is going to be like above 25% by 2027, there's going to be a chance that we will see like a diminishing EBIT in Allison's business. But I think like 25% is like too optimistic for like a EV roadmap, considering like it's for commercial vehicles. It should take like a much longer time. And right now, like most people, right now at this point, like the penetration rate is probably below 1%. So I think it's, like the penetration, EV penetration, even if like EV is going to like dominate the market, it really depends on how fast the penetration is going to be. Because as I said, the truck industry is not, the growth in truck industry is not going away. They are still going to grow with the economy by 6%.
Can I just follow up on that? So all the cash flow that they're going to generate in the near term before the end of the world, what are they going to do with that? Have they talked about are they going to return it to shareholders, pay down debt, make big expensive acquisitions?
Exactly. I think from their capital allocation, we can see that they have been very aggressive in stock repurchase and paying a little bit dividends. Their stock count has been declining like by 8% in the last 2 years, and I'm like forecasting based on this. Like if you see that since like 2017, they reduced their share count by like 36%. And one thing I didn't update it into this is that last night they announced that they are going to increase 11% in their dividends payout, and also they add like another 1 billion in their authorized share repurchase program. So now their total share repurchase program is like 4 billion. They probably not use them up, but the current market cap is like 4 billion. So yeah, they've been like giving this cash back to their shareholders.
My last question is around the cyclicality of the business and the balance sheet. How do you get comfortable with a company that is this levered in an industry that is capital intensive and that you've acknowledged is cyclical?
Yeah, I see. The leverage ratio, I think there has been like, they have kind of like a track record of like a high leverage ratio. That is mainly because Carlyle like did a leverage buyout of Artisan from GM. So like following that LBO, they have been always like very highly levered. The company used to target a 3 to 3.5 times net leverage ratio. And right now the leverage ratio I think is like below 3 times. Yeah, right now it's like net debt over EBITDA is below 3 times. I think the company is like the management is confident that they are going to like make sure in the long term their leverage ratio is going to be kept at like 3 to 3.5 times. And if you look at their track record in the past 5 years, I don't think like there's they have been like continuously refinancing their debts. So I think like refinancing is probably not going to be a problem. And if you look at the unlevered free cash flow in the past 5 years and comparing to the debt schedule in the bottom graph, I think they have like enough cash flow to pay back those debts. So I think it's just their kind of like they just have this history of like keeping their leverage ratio high.
Do they have covenants, maintenance covenants?
I mean maintenance covenants for
The debt.
on the debt. I think I haven't like looked into that. Sorry.
I noticed their parts and service are a big part of their revenue stream. And on one of your charts in your presentation, you talked about the average truck age. It's getting older. It's 8 years old now. And so I went back up to your P&L and I was looking at the trajectory of parts and service, expecting it to go up when actually it was coming down. And so I'm just curious if you dug through that a little bit to see what's happening
Okay,
in that part of the business.
I think the thing is that for that like as I said, the average truck age is 6 years. For that 6 years, I think it's for instance, so most okay, sorry. I think like roughly 40% of that service parts is actually coming from off-highway vehicles instead of on-highway vehicles. And in the past like 5 years, I think we are seeing like declining their off-highway revenues has been declining because like overall the mining activities were not that active in the past. So that's why their like impact their like service parts revenue. But in terms of like their on-highway vehicle, like as you said, like the truck age is like getting older. But I think their service parts revenue is like didn't actually change that much. I think that's because like this continuous replacement of trucks, and if you're looking at their historical revenue segmentation, service parts is kind of stable, so around like 20% of their revenue. Like it goes with the cyclic cycles. So I think for my forecast, I just managed to slide down a little bit because I think when they're entering into like electric solutions, there's going to be like a decline in service parts compared to their conventional AT business.
Okay, we're out of time for questions.
Okay.
Thank you.
Okay, so I'm pitching Flutter with a price target of £135.23, representing an upside of 28% on Wednesday's closing price, an IRR of 34%, and an upside downside skew of 2.3 times. There are four key pillars of this thesis. The main one and the most talked about at the minute being the US growth story. I believe currently the market is underappreciating that growth story, which presents a very attractive entry point for us today. The second is Flutter's known experience and history of operating in this space, executing both profitably and in a dominating way, which brings me on to market leading positions and also competition, which history has dictated is a key competitive advantage in light of things like regulation, etc. Overview of Flutter, as you can see, the last sort of 6 months has been a relatively choppy period, down about 45% of its highs last year. Flutter is a conglomerate of brands. Started in Ireland in 1988 with a merger of 3 Irish bookies. Today is a sprawling conglomerate covering over 100 countries in terms of operations, but with 4 key geographies being UK and Ireland, Australia, Italy, and now the US. In terms of their brands, most of you will be familiar with the US ones, I hope, particularly FanDuel. In the UK and Ireland, they are known for Paddy Power, Sky Bet, and Betfair, which are sort of the 3 market-leading brands behind Entain. In Australia, they're also the market leader with Sportsbet, and more recently, they acquired CSAL in December last year to take a market-leading position there in combination with their existing business, PokerStars. In terms of the overview, it's relatively diversified from a revenue perspective. The UK and Ireland, which is sort of the core where the business was established, is obviously the main contributor. Today, obviously, we see lesser on the US, but expect over time that will catch up and eventually surpass what we see in the UK and international Australia making up the remainder. You'll see in terms of historical EBITDA margins, and we'll come on to sort of regulation in a minute. Generally speaking, outside of the international side, which has been less of a focus for them until the CSO acquisition, that Flutter's maintained very healthy EBITDA margins in sort of the 30-35% range, which is industry leading, and that speaks to its scale. Just a little bit on the history of Flutter. So as I mentioned, it's really a conglomerate of brands, and how they've come about that and their sort of market leading position today is really about capital allocation and acquiring industry-leading brands that are either the second or third best in that market to maintain and dominate from a market-leading position. So first of all, they entered the Australian market in 2009 after the GFC, acquiring Sportsbet, which they've taken their position up. Interestingly, Flutter have a different way of acquiring businesses where they'll take a controlling majority stake but not outright position and build up that position over time as their thesis plays out. We've seen that with Sportsbet in Australia, and and we've seen that with FanDuel in the US. Paddy Power was the first ever mobile sports betting app. As I mentioned in the thesis, history and experience is a big part of this thesis. They've been around the longest, both from a sort of sports bookie perspective, but also from a digital perspective. Big pivotal one in the UK was when Paddy Power merged with Betfair. The two brands were actually the two market leading positions, bookies in the UK and Ireland, and then the acquisition made them sort of about a 10 percentage point difference between second place, which was pivotal. Then 2016 came along with Trump, and this is where really the US story started coming to bear. And in 2018, when the Supreme Court renounced the Professional Sports Act, Flutter merged with FanDuel, and that's really where you start seeing spikes, and the US story came about. Smaller acquisitions in Eastern Europe, and then more recently, thanks to the new management team, which I'll come on to at the end, a quite transformational acquisition in acquiring the Stars Group, which featured Sky Bet, PokerStars, Fox Bet, and TVG. There has been some volatility, as you see in the stock price. This is in part because of regulation, in part because of the market appetite towards the high growth stocks, and Flutter's coupling with the growth stock in DraftKings, which I'll come on to in comparisons. Okay, so first one on competitive advantage. So scale, I think, is exceptionally important. Flutter, through FanDuel and its other brands, maintains a quite clear dominant position in all of their core markets, which I think is compelling. The reason being, I'll show you this case study here. You just see the advantages of scale looking at Australia. So from a margin perspective, far more efficient than any of its competitors, yet spending nearly double their second closest competitor in terms of S&M. This is very helpful both from a retention perspective and also navigating regulation and pricing increases, which in Australia we've seen a huge amount of. As I mentioned, they're a historic operator. They have huge amounts of data on their customers already, unlike some of their peers. The data moat is extremely important, and you can see this in sort of the KPIs. Best pricing, but highest net win margin, which is very important, again, when we come back to regulation versus its competitors in the US. Flutter knows how to win markets. UK and Ireland is sort of the history of this, and we have that on the left-hand side. That's the combined of Paddy Power and Betfair. Then on the right, you also see Australia, which I think is an interesting case study because not only do you have a clear market leader now today, but if you look before 2020, you can see Flutter on a standalone basis. This was just Sportsbet, not with the Stars Group's Australian entity, growing that market share organically and very aggressively. Just looking at sort of that coming into the US now and how they're applying that. I mean, this is really the key debate right now and why I think it's unfair that Flutter has been coupled with DraftKings' share price. You just look at the comparisons in terms of marketing spend and customer acquisition, and then the returns in the bottom chart. Flutter generating a profitable return in the first year of operations and doubling that essentially in the second year versus DraftKings essentially loss leading. We'll talk a little bit about it, I'm sure, in the Q&A, but in terms of sustainability, with DraftKings potentially losing the capital markets now to finance customer acquisition, Flutter with a very high cash flow generation outside of the US can allocate profit sustainably and hopefully win from DraftKings. This is more of the same of what I was just talking about. Sorry, it's a bit of a busy chart, but again, you see Flutter in the blue as well as Fox Bet. Generally has been there or thereabouts versus DraftKings. I think it's going to be very interesting to see how this plays out this year as DraftKings' sort of capital constraints come to bear. In terms of the favorable secular tailwinds, I think we all know the US story is going to be a huge growth story. I personally believe the market is underappreciating that. We're just seeing the most tremendous numbers in terms of growth that you see here, a quote from the Caesars CEO when they were reporting earlier this week. This is the biggest growth opportunity that they've seen in 3 decades. I think this is really exciting, and the market is very much underappreciating this. Just in terms of estimates on revenue, I look here on the right-hand side, 12.5 billion. My target for 2023 is around the 2.5-3 billion mark. that obviously assumes a much lower market share than what Flutter currently commands today. So we're baking in some significant headroom. Obviously, COVID has transformed many industries, and online gaming or gaming generally is no different to that. You've seen here pretty sensational charts with regards to online penetration, both in Australia and the UK. I think it's very unlikely that this trend unravels, particularly with the ease and convenience of mobile gaming and the sort of preference of consumers to stay at home generally. Regulation is one of the risks in this thesis. There's been a lot of challenge around that, and there's currently headwinds in the UK. There has been headwinds in Australia, and just to show you how this has sort of panned out from a market share perspective, as on the left-hand side top chart, there was no point of consumption tax in 2017, and now that's roughly 10 to 12%. And what that's effectively done is wiped out a lot of the competitors. 10 operators back then, now only 6 today, of which obviously Flutter is the main leader with over 40% market share. Comps perspective, I think this is not necessarily a value play. I don't necessarily believe that. There is a big growth story, and you have to believe in that with the US. So I'm not pitching this as sort of a very attractive value, but as I said, the key is in my model that I've baked in a lot of headroom with the US, and hopefully that comes to bear. I'll just go quickly into the valuation setup. In terms of how we're looking at this, I'm applying a 10 times EV/EBITDA on the 23 numbers ex-US, and then using the FanDuel valuation of the minority transaction in December 2020. Side note, there is an arbitration going on right now with Fox that would suggest that the value is much greater than that, because that's what the arbitration's about. Fox are disputing that they should be acquiring it at the value of the minority and not market value, which Flutter believe is clearly above where they acquired it. So again, more margin of safety there.
Andrew, it's third time.
That's fine.
Great, thank you. All right, so again, we'll start with the judges on Zoom and then move into the room.
If I can you hear me? Yes?
Yeah, we can hear you.
Sorry, yeah.
Okay, thanks, Meredith. Well, thanks a lot, Andrew. I really liked this report and learned a lot from it. One thing I was wondering if you could elaborate a little bit on. I really liked your chart on your page 7, the way you kind of explain sort of why they, I guess, had like a competitive advantage from scale. And I was wondering whether you could talk a little bit more about that, particularly the kind of stake-weighted over-round versus FanDuel, like, showing how they kind of get better pricing. Can you talk to me a little bit more about how that works, like how they get that differential advantage?
Yeah, so the first thing on pricing is Flutter basically operates as an insurer, where all of their pricing basically comes from internal pricing models. Most of the market, with the exception of Entain, sort of I guess, in my view, Flutter's main competitor. The exception of Entain, most people actually buy that data, so it's outsourced. Flutter also creates those markers as a result of that internal pricing data, so that they have all this data on customers, they set the pricing themselves, and the rest of the market follows. So that's the first piece. In terms of scale and operations, they basically are operating 24/7. So, for example, the Super Bowl was actually priced out of Australia and Melbourne. That's something that DraftKings, with operations just in the US today, can't leverage. So they don't have this 24/7 pricing trading model. In terms of other scale, I pointed to sort of the Australia piece around margins. I think the interesting thing about Australia, and it was one of the risks I was talking about, obviously regulation is the key concern or risk in any of these markets, because Flutter's revenue, 90% comes from regulated markets, which is a good thing. Stable, but obviously you get the increase of regulatory scrutiny. The difference with Flutter and its peers is Flutter has a lot more margin of safety and can pass through some of that through pricing increases, and that's what you've actually seen in Australia. So if I go back to the Australia margins, so their cost of goods sold have actually gone up 17 percentage points, yet they've been able to increase EBITDA margins by about 10 percentage points. And that's a reflection of being able to pass through increases to their customer. The other point on regulation is essentially the smaller guys can't afford to operate because your cost of goods sold are going up. So you become a lot more, just become less profitable. And you're starting to already see that in the US. It's a slightly different story because it's about cost of acquisition. But you've seen that in Australia. You saw it in the UK. And basically all these markets at maturity concentrate to a handful at best. And typically, it favors the one or two biggest ones because, as I said, they can pass through onto their customers and maintain margins.
It's curious. It's a good question, Carl. And the method that they use, the insurance method, is also pretty interesting to think through. How visible is that to the customer? If the win rate is better on one platform versus another, do customers really notice? And is this like other gambling operations where you have this loyal set of customers and they make up a big percentage of your business, and people like that do notice a difference? So maybe you can talk about that.
Yeah, so I actually did some customer referencing on this. And basically how it works, at least in the US. So in the US, I showed you the chart that essentially Flutter, this basically says that FanDuel's the worst odds. You get the worst odds on this, and everyone else is better. What happens is, or at least in terms of what they've observed, is you have your core app, your core betting app, and then you'll have others that you opportunistically look for promotions and better pricing. But generally speaking, except for the top 5% of gamblers, sort of the whales that they monitor and they can turn off, most people are price insensitive because they're not doing this on a sort of a professional level. They're doing it more for entertainment. They're literally just punting. And so there's actually more stickiness. What actually matters more is the UI and UX. And again, I didn't actually touch upon that with sort of Flutter Scale, but because they have all the technology in-house, they develop it themselves, they have all this data on the customer preferences, they've created a better UI UX, which creates stickiness with their customers.
How much of the business are from the whales?
A very small percent, because they should shut them down, basically.
What's the
I had a. Go ahead, Jimmy.
what's the ultimate margin of this business, and like after all the integration's done, and what revenue run rate will it be at that margin point?
For the US? Yeah, so the US is 55% of the US is legalized in terms of online sports betting, and I'm just going to leave out gaming for now because that's a bit of an unknown piece right now. The forecast is about 7 to 8% of that population remain that 45% to come online until you reach sort of critical mass, with the exception of probably 5 to 10% of the US population, with some of the red states will just never legalize. After that point, the belief is that it's a 3% to 4% grower on top. If you look at the UK and Ireland, that's roughly consistent, and where you basically increase your growth moves to the bottom line, and that's sort of a 30 to 35% EBITDA margin business.
Can you talk a little bit about the customer acquisition costs for a business like this, and how you think about that in the context of the value?
Yeah, it's an interesting one because the cost of acquisition is twofold. It is the investment in marketing, conventional marketing that you see, Subway ads, whatever it would be, but then also the promotions, right? So free bets, etc., which you see actually separate to this. So when we look at DraftKings' CAC, that's literally just on the sales and marketing spend. That excludes promotion. Promotion comes out of a net win rate, and so when I showed you the net win margins for Flutter, at a significantly higher, the 8.3%, that's a result of them offering less promotions. So you should look at the cost to acquire basically as twofold. So it's the sales and marketing, yes, they're clearly very efficient there, but then also on the promotion side. But looking at this is looking at just the S&M side. Flutter, and to their management's credit, I think this is going to help with earnings next week. they're laser focused on profitability. A lot of actually the market noise last year was, oh, they're focusing on profitability too soon. They're not going to acquire as many customers as DraftKings. DraftKings conversely, obviously, guided to wider EBITDA losses this year. The stock price came off 20% last week as a result. Again, it's unsustainable customer acquisition versus sustainable customer acquisition. So I see this as like healthy, considering how much of an arms race we're in right now, to be at 1.2 times return in your first year on a gross profit basis. And then they're obviously doubling that, so it's 11% growth on the revenue figure, so roughly a 2.5 times return 2 years after. So I think pretty attractive unit economics in the US, particularly considering it's obviously very competitive right now with a lot of people throwing cash at trying to acquire customers.
I have two quick questions.
Okay.
You mentioned on one of these slides, you break out the ex-US return on capital.
Yeah.
And it seems modest.
Yeah.
So my two questions are, what's going to change in that number, which I think would really help the multiple, because the multiple, as you pointed out, historically hasn't been that high or demanding. And the second thing is, can you just summarize what's the single biggest thing that's going to drive the revaluation, or what the market has wrong today that you think they'll get more visibility on and drive the share price up?
Yeah, so I think I'll just take the second question first. I think the single biggest thing is demonstrating that the US growth story is there, but in a sustainable and profitable manner. So DraftKings, second leader, arguably the top in terms of market share, guided to wider EBITDA losses this year, sold off 20% because there's no route to profitability. So the market's now challenging.
Way they do things.
Correct.
And they overpay for customers.
Exactly. And Flutter, the narrative has always been, prior even to this current earnings season, we're going to grow profitably. We're going to have break even towards the fourth quarter of FY22. I think the key is demonstrating that to the market, that they're still on track to that, and that they can maintain a market lead.
What tells you the 1.2? What's the visibility on the 1.2, and then the ROIC levels? Because that would suggest maybe they're overpaying for customers or acquisitions.
1.2 times, so 1.2 times gross is the amount of gross profit over the CAC, sorry.
Is it visible, or is that from management? I mean, can you see it in the numbers? Or?
Yeah, it's from management. It's not visible. I think the proof's going to be in the pudding when we see the earnings next week. It's not possible to break out from the way they disclose. It's just from the investor presentation.
And so are they overpaying for acquisitions, or why do you think they have these ROIs?
Oh, yeah.
Excluding the US.
Yeah. It's a tough question. I mean, again, there's effectively very low barriers to entry, other than regulation, which in itself is a good barrier to entry. But to maintain market position, you do have to invest pretty heavily. And I think that's probably what's driving down the returns on capital. And the reality is, you're looking at mature markets in the UK, Australia, and international, and that you're still having to invest, right, to maintain that market leading position. It is profitable, but it's not your 20-30% returns. I don't think it ever is going to be.
We have time for one more question.
I think Jason wanted to ask the question.
Thanks, James. Hey, I have a question. In your model, you have on your free cash flow in the core market ex-US, you have free cash flow going down 21, 22, down 22, 23, 23, 24. What's the cause for free cash flow in the core markets ex-US going down over the next several years?
Yeah, that's a bug. I basically hadn't adjusted the cash flow for the pro forma acquisitions that they've done just in December. So apologies for that. That's what that is. It should be increasing.
Oh.
James, you want to ask your question?
Yeah, I'm a little confused. It's like you have a huge depreciation and amortization rate of like mid 700s, but your CapEx is only 354.
Yeah,
the
I should have
delta,
broken out.
the delta is like,
yeah,
and that's a GAAP EPS, but shouldn't you add the free cash flow back to your EPS to get a true economic earnings power?
Yeah, no, exactly. So basically, I should have separated out. It's a separately disclosed line item that's about, so in 2020, it's about 400 of that 646 DNA.
So
And
you should
that's-
add $2 of free cash
Right.
flow.
Right, yeah.
Okay.
Exactly.
Sorry, what's that line item? I didn't hear what you
It's to do with the acquisition of the Stars Group. It's an exceptional of roughly £400 million related to amortizing deal costs, which I haven't broken out. And on reflection, just before this, I realized I should have, because it artificially sort of deflates the earnings below. So I think you should expect to see that improve.
You know, just in general, investors don't care about GAAP EPS, they care about free cash flow. So how much money they can spend on dividends, buybacks, reinvestment back into the business.
Donna, cover your ears.
I know, this is outrageous.
Thank you, Andrew. Good job. Go ahead.
Good evening. Thank you so much for your time. Now I would like to pitch KKR as a compelling law with a 5-year price target of close to $130 per share for an IRR of 17%. Since its listing, KKR has outperformed the market by over 200 percentage points. It has not been a smooth ride. In its first 5 years as a listed company, it actually underperformed the market. The main reason is that it was listed as a public partnership, and there are a lot of restrictions on institutional investors, barring them from owning its shares. There are also concerns regarding the volatility of its earnings. But a major inflection point happened in 2017 when the Trump administration enacted tax reform, prompting all alternative asset managers to convert their business into C corporations. Alongside strong underlying performance, KKR outperformed the market significantly in its second 5-year period as a listed company. But if we zoom into the last quarter, actually meaningfully underperformed, mainly due to rates and macro concerns. So against this backdrop, why should we expect KKR to more than double in the next 5 years? Before I answer that question, I would like to give you a brief overview of the KKR business. So KKR currently manages close to $500 billion in AUM, and it's not just a private equity shop anymore. In addition to private equity, it runs strategies ranging from infrastructure, real estate, credit, and etc. The main reason why KKR stands out in this industry is the fact that it has delivered great returns. So since inception, more than 45 years ago, its investment funds have returned double the returns of the indices. And at this point, KKR's capital base is very sticky and stable, with nearly half of it considered perpetual. Finally, it's differentiated from its peers with a very mature capital markets business and a big balance sheet of its own investments. The market KKR operates in is massive and is still growing very nicely. Over the past 2 decades, alternative as an asset class have gained market share continuously because capital keep pursuing higher investing yielding investments. By 2020, the alternative asset class has 15% of the global $100 trillion asset market industry. And because of the higher fees it charges, it actually controls more than 40% of the revenue pool. This part of the market is expected to continue to grow to high single digit in the next few years. And KKR has actually performed even better. Since 2009, it's grown its AUM by 20% per annum, increasing its market share from less than 1% to a current level of 3%. And in terms of revenue, KKR has 4 major revenue streams. The first is fee-related revenue, coming mostly from management fees and transaction fees. Second, realized performance income. Mostly that's realized carried interest. Third, realized investment income. That is investment income coming from KKR's own internal capital. And fourth, the insurance income that's coming from the recently acquired Global Atlantic business. And as I'll explain below, the fee-related revenue is really a key value driver for a business now, and it's three main sources diversified, shown on the right. So going back to the question, why are we presented this opportunity? I would like to address three major concerns the market has on the business. First, potential impact on earnings from market drawdowns. Second, impact from rising interest rates. And third, specific concerns regarding the riskiness of KKR's balance sheet investment strategy. And in this following section, I will explain why I think each of those market concerns is overblown. First, let's address the concern on earnings. So private equities historically does rely a lot on realized carried interest. And so there's concern regarding whether alternative asset managers' earnings will be impacted or very tied to asset valuations. And so if there's a major market drawdown, probably asset managers' earnings will fall off the cliff. This concern is particularly prominent now as we have been near the top of market valuations for many years, and we're finally seeing some cracks. However, in reality, fee-related earnings, FRE, increasingly constitute the bulk of economics earnings for these asset managers. Particularly for KKR, last year, FRE was twice the level of realized carried interest. And asset valuations have minimal impact on FRE because the main component, management fees, is actually based on capital invested and not NAV. And additionally, if there's a really major market drawdown, KKR has a lot of dry powder to take advantage of the market dislocation. What about interest rate hikes? Are they wholly detrimental to KKR? Private equity does use a lot of leverage, so it's natural to have concerns regarding future returns if borrowing costs increase dramatically and if valuation subsequently adjusts downwards. Inflation is a related topic, very heated topic lately, and it can definitely eat up investment returns. So together, there are concerns regarding demand for alternative investment products going forward. But I'd like to remind everyone that KKR is no longer just a private equity company now. For instance, it has a large and growing credit business, managing nearly $200 billion these days. And the bulk of that business has floating rate exposure. So rising interest rate will actually benefit that business. The same goes for the insurance business. Furthermore, the current anticipation of higher inflation is actually driving demand for investment products in infrastructure and real estate, as investors seek assets that will provide better inflation protection. And finally, regarding the riskiness of KKR's balance sheet strategy, KKR does run one of the biggest balance sheets in the industry, investing its own capital alongside the funds that it manages and also in other proprietary investments. So as a result, KKR is often described as having more market and leverage exposure. While it's true that the funds are operated with leverage, the corporation itself actually has minimal leverage. KKR now has net debt of around $2 billion, and last year generated FRE of $2 billion. So net leverage is essentially at 1 times highly recurring and stable earnings. And the balance sheet strategy does provide some clear benefits, including allowing KKR to share more of the deal economics and allow KKR to invest in new strategies more aggressively for growth. Now coming to valuation, I'd like to walk you through a sum of the parts exercise. So first and foremost, the fee-related earnings. Again, this is a highly stable earnings stream, not tied to any fee fluctuations. And remember, KKR currently has a very stable and sticky capital base. Since 2009, it's grown its FRE at 15%. I would argue that this earnings stream is worth at least 20 to 25 times, giving us a value of $45 to $56 per share. The second part is the balance sheet and its stake in Global Atlantic. In addition to investment in cash, there's around $10 billion from net unrealized carried interest and other assets. Those are the more uncertain parts of the balance sheet. But even if we cut those in half, we're still going to get to book value of around $24 per share. And I would say these two businesses should be worth at least 1 times book, since they have been able to generate returns in the mid-teens. So these two segments together would get us to around $70 to $80 per share in value. And then there is the performance-related earnings. This is the least predictable part of the business and worth a much lower multiple. I chose 10 times, and that gets us another $10 per share in value. So in total, we have around $80 to $90 per share in value, around 40 to 50% above the current stock price. Finally, I also did some projections to derive at my 2026 price target. The one major thing I really want to highlight is the fact that even in this bear case, I think the downside risk is limited. And the main reason is that I believe the certainty of FRE growing over the next 5 years is fairly high. Right now, KKR has 38 billion of AUM that has yet to pay any fees. This part of the AUM should generate at least 215 million in FRE. So for KKR to really get to 2.8 billion in FRE by 2026, as suggested in my bear case, they really only need to generate an additional 500 million in FRE. And they could get to that with around 50 to 100 billion in incremental asset over a 5-year period. I would say unless the work really falls apart, even their track record, the likelihood of them not hitting that target is very low. And also identify some key risks, including prolonged market drawdown, impact from prolonged market drawdowns, some regulatory risk and market competition. Happy to discuss them further in greater detail in the Q&A. Thank you so much for your time.
Thank you. Do the judges on Zoom want to go first? Jason?
Yeah, what are your thoughts on the General Atlantic acquisition, and what are the main product lines for General Atlantic?
Global.
So General Atlantic is a retirement and annuity business. I think it's really a great acquisition for KKR. They bought it at slightly above book value, and it provides KKR with several key things. First one is highly stable capital base. Most of the 100 billion as an insurance company can be really considered perpetual capital, very long dated capital. So that's one thing that adds to the perpetual capital base of KKR significantly. And the second point of that acquisition is really for KKR to expand its distribution channel. Right now, there's a trend of this top-tier asset managers trying to tap into the retail market, and historically, that obviously has been the weaker part of the business. But this annuity business is highly reliant on the retail channel, so tapping into that, there's, you can say, revenue synergies on that front, as all these top-tier asset managers trying to create specific products that can be sold to the retail customers. So it really adds to KKR on those two fronts.
Are there any concerns on the hedging on the annuity book?
I've tried to done some work on it. I look into the ratings from the rating agencies in AB Best and S&P 500. There's really no major concerns there. They have really high ratings, A to A minus. I don't think that is a big issue there.
I think maybe the lockup gates make this situation different, but I've actually lost like a lot of money on asset managers before because, and granted, they were much smaller than this one. But if 2 or 3 people leave, and then the consultants come in and they review everything. Again, the gates probably stop that. But are there 2 or 3 things events or people that could leave KKR, and they would take a lot of clients with them, or did the gates just stop that from happening?
That's a great question. I do think the gates does stop that from happening, and more importantly, I think the dynamics within the private equities or alternative asset management space is very different from hedge funds, where really a few key people dominate the whole investment process. This such big institution, they really get assets because of the KKR name, rather than just some specific investment professionals. That's at least the perception.
Are returns better? Are their returns better than other private equity firms?
I mean, it depends on the funds. I would say they have been at least comparable to all the biggest names. That's not really been a problem for them. You can see that their capital raising has really ramped up in recent years. There are no issues raising bigger and bigger funds. So I think that's really proof that shows that there's they're not doing any worse than the biggest guys.
I take their fee income and I divide it by the AUM.
Sorry?
If I take the fee income and I divide it by the AUM and I do it over the last few years, the fee has gone down dramatically.
Mm-hmm.
Can you talk a little bit about that?
Sure. So they do have let me see if I could show you. Yeah, so they kind of segregate their AUM into private markets and public markets. But Actually, in the private markets book, if you look into specifically the fees in that space, it's been fairly stable, above 1%. What's causing the overall decline is really the growth in the public markets book. That's mostly the liquid credit investment products, which have much lower fees. But overall, I would say, going forward, unless they make another acquisition, because the global ethic acquisitions really bulk up their public markets book.
Gotcha.
Unless they do something similar, it should stay roughly the current level.
Can you talk about the promotions of Joe Bay and Scott Nuttall, and if you've looked at their compensation agreements and sort of how that comports with your view on value?
Mm-hmm. Sure. So first of all, yes, Henry and George, they kind of stepped back from the business last year, and they promoted Joe and Scott. They are both very long-time employees in the company, and they've made significant contribution to the business. Joe was the guy who went to Hong Kong to basically build their Asia business, and Scott is the one who helped list KKR and also create the proprietary investment business. So they were in the position of trying to build KKR to its current state. And in terms of their compensation, as you can see here, both of them take very low base salaries. Bulk of their compensation really comes from sharing from the carried interest and also other incentive fees. So I do believe there's an alignment of interest for them to really make sure KKR can produce the best investment returns for their LPs and thus the shareholders.
So the way that I tried to sort of internalize the valuation is I started with the market cap, subtracted out their portfolio investments. The number that I got from your spreadsheet was 23 billion. You have a couple other numbers in these, but it's close. It's in the 20s, and some of that is unrealized appreciation, right?
Mm-hmm.
Right. So, and then the insurance, I just took it at book value. It's small. It doesn't matter. And then the debt's a couple billion. It's also small. So you get an EV of 26 billion, and then I expressed that on top of the earnings, including carried interest and excluding carried interest.
Mm-hmm.
Right. So it comes to 9 times EBIT, including carried interest, and 13 excluding. You know, what do you think about those multiples?
Well, first of all, can you let me know what market cap did you use in your calculation?
50 billion.
Okay, 50 billion. And then you get to, sorry, what's
Well, by the time half the market cap is their investments, right?
Right.
So just assume 25 billion,
Yeah.
right? And then you take the operating profit, you can use it either including the carried interest gains or excluding, right? So it's either 2 billion or 3 billion.
Mm-hmm. I do think that's a fairly conservative multiple. The way I try to look at it is the sum of the parts that I mentioned. But if you're letting me know that I could buy this franchise at just low double-digit earnings power, I think that's really still. And mainly, I would say the reason is, I guess I could try to answer your question on why are we getting this kind of opportunity right now in another sense. And I would say there's like 3 aspects to that question. First, very interestingly, I think there's limited investor attention to the stock. In our AVI class this past semester, we looked into 7 to 8 stocks, and KKR is actually one of the biggest stocks I look into. If you go to TGIS and look for transcript, you can only find 2 transcripts on KKR. Even a very small niche software company I look into, with a market cap of just 3 billion, it has like 20 transcripts. So for some reason, there's like some bias against us asset managers looking into another asset manager. So that's one. And then the second point is really, I think, the long-term growth potential of this business is really underappreciated. If you do my research, the one big thing I've come to is to realize how strong the flywheel effect really is in this business. The flywheel effects come from deals, capital, and talents. The more deals you do, the more relationships you build, better access to future deals you have. And on the capital side, which I've done some work talking to some capital allocators, there's really a trend towards consolidating the capital. They want to reduce the number of investment firms they interact with. So they're increasingly allocating more capital to select few investment firms across different strategies. And then in talents, you talk to my classmates, both of them who are really interested in the private equity side would want to go to just those top firms. So you can see that the scale begets scale, and the bigger the business gets, the better it gets. As a result, I do think the trajectory for growth, duration for growth is very long. And so, to your question, the low teens multiple, I think is really very attractive.
Just try to sort of internalize it this way. If you got 5 more multiple points on the earnings, right, and that's what's going to drive your expected return, you have to divide that expected return by the entire market cap, right, which is 50 billion. It's double the allocated enterprise value to the operating business, right? So that significantly dampens your return. Really requires those investments to do well along with the business. I can explain that to you later if you want.
But the way I would love to discuss further that with you, but here in my base case, even I get to 17% ROI, but I'm not assuming any changes in the balance sheet cash and right. Just mostly from FRE growing at low double digit.
Have you done a comp on other asset gatherers and what they trade for PE? Because they don't trade at last time I checked, which was a couple of years ago, they don't trade at 25 PEs.
Well, I guess it depends on the type of.
But they were generally mutual funds, not.
Right, but I think if I remember correctly, T. Rowe Price, for instance, they trade at like 30 times PE. I think that
was the outlier though. But if you look at Pazina or Gabelli,
Artisan.
I guess my argument is that the KKR with this base of this peer group is the T. Rowe Price of the mutual funds world. They ought to deserve fairly high multiple, just given their brand name and their ability to keep raising capital at an increasing rate, and that capital being very stable, doing great investments in this space.
Is there such a thing as too big? You know, I get the flywheel, but you know, at some point you're the market, right? So how do you? Well, it's a trick question, I guess. You can tell where I'm going with it, but I think about that as compared to the 20 to 25 times multiple, and you know, I'm just not sure. Is that something that you've thought about?
Sure, that is a great question. But I would say, just looking at how massive that industry really is, even in the alternative space, there's 15 trillion. Blackstone currently will hit 1 trillion this year already. And in my model, I'm just assuming that KKR will hit nearly 1 trillion 5 years out. So I would say, yes, there could be a potential ceiling to the size of these asset managers, but they're still quite far out, and I'm not too concerned about this within the next 5 to 10 years.
Okay.
Thanks, Dixon.
Thanks.
You should have gone after leverage buyout.
Ready?
So my name is Will Husick, and today I'm going to be pitching Match Group Long. Through my research, which consisted of numerous calls with industry experts and analyzing alternative data, I've concluded that Tinder, Match's core asset, can grow at a rate of 20% for longer than expected, that Match's emerging brands, specifically Hinge and Pears, will grow faster than expected, contributing to above-street top-line growth, and that this business has significant operating leverage. As a result, I'm long Match for 23% IRR on a 4-year price target of $236, which is exiting on 30 times 2026 free cash flow. My thesis has 4 main points. First, Tinder is the global leader in online dating. They are 4 times the size of their next competitor, and I believe the only app with both global and local network effects. The online dating industry is underpenetrated. I believe Tinder is set up to have very strong long-term monetization. Second, emerging brands such as Hinge and Pears are only 12% of the revenue today and are growing at over 50% per year. I believe these apps have a substantial runway and are better monetized than even Tinder, creating long-term growth potential for these as well. Third, while Match is primarily driven by secular trends, there has been a little bit of a COVID headwind in this business, and I think this stock is set up very well for near-term rebound growth. Lastly, Match's operating leverage has been masked by the recent cost structure that I believe are mostly transitory and one-time events, masking their true operating leverage. I think there is also some asymmetric upside optionality when it comes to potential changes to App Store fee commission changes. So why invest now? Match is down over 40% from the highs in October, and the multiple has been cut in half. However, I believe there have been no changes to the fundamental story of this business, and as the business recovers next year after COVID headwinds reside and they return to expanding margins, free cash flow will accelerate meaningfully. I also want to be involved now because Hinge is going international this year, following the Tinder playbook, which saw many years of very robust growth, and think now is a very attractive time to get involved. So what is Match? It's a global leader in online dating. They have a brand portfolio over 40 apps. Today, Tinder is the main source of their revenue at over 50% of the business, and that's come from growing at a rate of over 50% in revenue per year. They have two other brand categories, the first being emerging brands, which are growing over 50% per year, and established brands, which are mid-single-digit growers. How Match makes money is monetizing its users through subscriptions with a metric called ARPU, and a la carte purchases, which are individual one-time purchases that add up to a metric called RPP. So starting with my thesis, Tinder penetration is low. That's in terms of the total industry of people using online dating, as well as Tinder's penetration of their users for what their payers and subscribers are. Today, Tinder only has 11% of their users as paid subscribers, and I believe that can grow to 20% in the next few years based on a great analog that 25 to 35% of MAUs in more mature and developed markets are subscribers. So I believe that gap will bridge over time, and those data points are supported by my expert calls as well as analyzing alternative data. Stepping back a little bit, thinking about the industry, we are still at single-digit penetration of users for online dating, and even lower for payers when you adjust the fact that people have 2 or 3 apps, and that's not factored into these penetration numbers when you think about that from an active single perspective. The second part of Tinder's growth algo is pricing. As shown in the chart in the top right-hand side up here, Tinder has exhibited more pricing power than other at-scale consumer internet companies. I believe this is due to very strong new product launches, and specifically, they've launched Tinder Platinum last year, which today is 13% of subscribers and 28% of revenue, which is a very high, their new highest priced product, which I believe has a long tail for growth. Thinking about the international opportunity for pricing, the US is monetized 2 times better than the global consolidated metrics. Tinder ex-employees said a big goal of the company was to bridge that gap through launching a la carte and cheaper options in international markets and getting people to pay more. I believe that gap will close over time. An interesting tidbit that I learned from analyzing Tinder lawsuit documents was they actually have a 52% EBITDA margin. And that's a best-in-class margin in the internet space, only shown by companies with substantial pricing power. Turning to the second part of my thesis, which is on Match's emerging brands, I want to start with Hinge. Hinge is 1/3 the size of Tinder in the US and 3/4 the size of Bumble, so there's still US runway. However, it's only 11% of Tinder when you look at it on a global basis. Hinge MAUs today are less than 40% international and primary in English-speaking countries versus Tinder, which is over 80% international for perspective. Hinge is only monetizing those US users, and they're planning to launch this app fully internationally in 2022, following the same Tinder playbook where we saw multiple years of triple-digit growth. The second part of Hinge is that they have very attractive economics. They have higher ARPU and RPP versus Tinder because it is a more mature app for a more serious dating user, and they're willing to pay more. You can see that as well in demographic stats that show Hinge average age is a bit higher than Tinder, and they have a more willingness to pay because it is for more serious relationships. When I think about revenue potential for this business, I think they can do $1.2 billion in revenue by 2026, which is well above street estimates,
but also compares to Tinder today, which is only doing a little over 1.6 billion, so still smaller on a relative scale basis. The second emerging brand I want to talk about is Pears. Pears is the leading dating app in Japan. In terms of popularity, it's second on the App Store, only behind Line, which is basically the WhatsApp for Japan. Pears is estimated to have grown revenue over 55% per year for the last 5 years, and Japanese online dating penetration is still low single digits. Pears revenue was actually flat in 2021 despite this 5-year growth rate because COVID restrictions were very strict in Japan. You can see this in my MAU data and downloads data, which shows that there was a decline when everything locked up in Japan. For the icing in the cake of how attractive Pears is, they monetize Pears 4 times better than Tinder per app data. The third part of my thesis is that this is a bit of a reopening play. And this is shown in the numbers in the charts on the right side here that APAC and emerging brands were the fastest growing segments before COVID, but during COVID, management said there was a 20-point hit to growth in these segments. And I believe that is set up for a very strong rebound as there have been no changes. These are still the leaders. These are still fast-growing brands, and Match is still doing a great job investing. Why this is interesting is because Match doesn't really disclose a lot of information on this, so it's difficult to calculate. It's not in their guidance, and I believe this is something that most of the sell side, at least, is not modeling into this level of granularity. Lastly, in my thesis, Match has been one of the best S&M leverage stories in consumer internet. EBITDA margins grew from 2015, 27%, to 36% in 2021, despite gross margin contracting meaningfully. Gross margin contracted as Tinder made up a higher mix of revenue growing so rapidly because they pay very high commission fees to Google and Apple. They increased some legal expenses due to lawsuits that were ongoing, and they invested in video and voice, which has been largely completed and about to be rolled out. Margins were actually down in 2021 due to a margin dilutive acquisition and additional legal expenses to wrap up a Tinder lawsuit. Going forward, even if you assume a little less S&M efficiency with the Hinge international rollout, things should return back to normal and this should exhibit operating leverage just as they've done in the past with a great management team. There's also some upside optionality to play for. I believe it is completely asymmetric and in Match's favor because right now there's a lot of pressure on Google and Apple to lower the 30% fee that they're charging to app developers, and Match would be a huge beneficiary of this. 2/3 of their cost of sales are commissions paid to Apple and Google, and when Match can, they're allowing third-party payments, which are cheaper. They're experimenting with virtual currency to try and avoid this. But to really quantify this, if Apple were to cut their fees or they were to allow third-party payments, I estimate there could be 500 basis points to gross margin upside. And quantifying that today for 2022 on a pro forma basis would be a 16% uplift to EBITDA margins. This is not in my base case, but I believe optionality that's worth playing for. Turning to valuation, Match has the best-in-class free cash flow conversion, a very attractive forward PE versus peers, and I think exiting at 30 times free cash flow is very justified for a business with this margin potential and growth profile. My exit assumes 2 turns of multiple burn down per year, and if you want to be more conservative, there still is very attractive IRR. But I will say to adjust that multiple, if Hinge outperforms, there's an argument that 30 is too low. To support valuation, Match is actually comfortable running with operating leverage, leverage on debt. This is unique for a consumer internet company. They'll run with 3 times leverage. The cumulative cash flow they generate through 2026, as well as their balance sheet capacity by this time, they could repurchase 45% of their market cap. They've made acquisitions in the past like Hinge, but I believe this provides a great floor to think about for valuation. To very quickly wrap up on risks, I know I'm running on time, Tinder US MAUs have been flat for the last couple of years. However, during this time, they've grown revenue 53% per year. This is because downloads are very stable and 1 million people are downloading Tinder in the US per month, and that's the key metric to track. International competition, Bumble is taking a little bit of share in India because it is a female-focused app in a male-dominant market. And there are some international markets that may never monetize like the U.S. That's roughly, I believe, widely known. It's factored in my model. Not as much of a risk. It's just something to be aware of. They won't be the winner everywhere. And lastly, on Hyperconnect, they made an acquisition. They cut the revenue targets for this very soon after they acquired the business. This, again, is widely known and I think priced in. And speaking to former Tinder employees as well as former Hyperconnect employees, the true point of this acquisition was for the data, the technology they acquired, the management team, and geographic expansion. And with that, I'll open up to questions.
Okay, I had a question. So regarding cost of acquisition, customer cost of acquisition and lifetime value, are there any metrics around churn?
Yeah, so depending on the app, this gets really tricky to calculate because it all varies by app and what subscription level customers have. But the average, if we want to just look at very high level averages for a subscriber on Tinder, they're usually on for anywhere from 3 to 6 months, and they're paying $15 to $30 a month. And their customer acquisition cost for this is really based on downloads, and it's very difficult to parse out what it is, but it ends up being a few dollars a customer for potentially $60 of revenue on average for Tinder. For Hinge, the lifetime value is higher. A lot of people actually have 12-month subscriptions for Hinge, which is really interesting based on app data, but we don't have a lot of visibility into CAC because they give us blended lines, and there wasn't a lot of color on that. But the LTV, the CAC is really, really high for these businesses, just given they have millions of downloads per month of new users who are continuously coming on the platform.
And you map the downloads to marketing costs, sales and marketing? Is that?
It's so it's tough because not all downloads become subscribers. So where subscribers is it's almost impossible to calculate a CAC for subscribers just because it fluctuates so much quarter to quarter for the different apps. But yeah, I would say downloads is the right metric because all users on the platform, if I'm only going to go on if I know there are thousands of other people. I'm only going to pay if I know there are thousands of other people. So it's not necessarily the payers and subscribers you're worried about. It's that constant use of users on the platform that makes people want to pay.
Okay, and one thing, since Hinge is such a big part of the thesis, is just it's kind of social question. Is it? Do you have line of sight that it projects to foreign markets? I think you have it really growing in Europe significantly. Does it just translate from the U.S. to Europe?
Yes.
Your opinion?
Yeah. So
points around that.
Yeah. First of all, on the international markets, the growth in UK, Australia, Canada, I'll exclude because it's very similar to the U.S. But English-speaking countries that are different than the U.S., especially UK, has been very, very strong, and they're not even marketing or targeting expansion here. So the early international, I guess I'll go back to the slide that shows the MAUs. You can see it's been really, really strong, outgrowing the U.S., and it's been dominant here. Speaking to competitors about this, actually, it was pretty unanimous that Hinge developed some new products. So they have something called Hinge Roses, which multiple competitors in online dating, both formers from public as well as private, say this is one of the best innovations in online dating in terms of a la carte individual purchases. That's been pretty unanimous from people of different backgrounds and success you're seeing in some markets so far. A wide range of customers. So customer preferences for how they pay for dating is mostly based on what they can afford. And it's a low-price, one-time purchase product that basically puts you to the top of the queue, sends a special note to somebody. So it's that right price point where the biggest gap, like versus India or versus cheaper markets, is people just can't afford or won't pay for the subscriptions.
I know Match is kind of a unique business model because of the churn, but is there any other business that this can be compared to that it ultimately fulfills or aspires to? A margin profile or a business model profile?
Sure.
Like you can comp like Pepsi and Coke or something like that.
I would actually say, so Spotify and Netflix, surprisingly, when you look at the implied annual churn and the prices of the products and how much you get free users or promo.
Those margins, Spotify doesn't have an EBITDA margin yet.
So I guess I was talking about in terms of comping for churn.
How about business model?
For
including the churn, however you want to figure out.
Okay.
What is this?
I think you meant for churn, what you look for churn. To be honest, when I think about the potential for this business and margin trajectory, this reminds me of like a Facebook or a Google, honestly. I think it's in early stages of having that level of pricing power, having that much of a monopoly.
Match has been around since I've been single, so it's been a long time.
Hinge and Tinder stage. Tinder really started 2015. Hinge started 2 years ago. Those are the mobile change in online dating innovation versus Match.com. To be very clear, I think is what I'm talking about when you compare what Facebook's done on mobile as well as, some of the stuff that Google's done. So when I think about internet and what their growth profile, what margin profile could look like 5-6 years down the line, and you can see my estimates here, just on like at EBITDA margins. This is getting to Facebook, Google level. They have the same pricing power on everyone's phone. Everyone's using it. They're monopolies. Those are the very similar characteristics for Tinder and Hinge, to be very clear, not Match.com.
Can I ask you, this may be a totally dumb question, but do they have some secret sauce that makes you confident that they'll continue to dominate the landscape? Like, is it the program? Like, what is it? Because, I see Hinge coming up so strong, and my first thought is, holy shit, I guess there are no moats in this business because somebody pops up out of nowhere. So that's the first thing I think about.
That's a great question, and I think, so interestingly, Hinge was acquired by them, and before that, Hinge was not growing at all. Match saw the potential in Hinge, and what I think Match does excellently is they are, and speaking to the management team, confirm this, they are able to really target areas, and they go in, they plant the app, and they market super effectively, and they're able to really do an excellent job of getting local network effects with a global brand, and it just scales so rapidly. Tinder, I believe, truly has a moat, because if you live outside of New York City, I think sometimes we get New York City bias that there's a million apps, you can do whatever you want. But if you live in maybe a rural area, the only place you'll go to find people on the app is Tinder, and you're not going to leave because that's the only place you find people. And when you join the app, that's the only place you'll get substantial matches. And there's data that kind of parses this out. So Tinder truly, I believe, has that type of capability. And the way that Match was able to quickly launch Tinder and generate these local network effects that scale so rapidly, they're able to run that playbook again for an app that was growing flat, Hinge, and make it grow 200% per year. So it's really a combination of excellent playbook and having that Tinder strategy in place, as well as just being a very effective marketing business. Just to in a long answer, but to comp to Bumble, Bumble, per even ex-Bumble employees, has lost its identity. It first was launched to compete with Hinge, and maybe, or at least like when it became much broader and it went public, it was more, we're going to compete with Hinge. Now today, people view it as a second to Tinder, and that's from even ex-Bumble employees saying they're trying these in-person things. They tried Bumble BFF. All this stuff has failed because Match has solidified identities for these apps, and others are not able to do it, and they can't grow as fast.
Last question. Can you just talk about the COVID-related impact?
Sure.
And how you think about, just if you were trying, I know it's difficult to isolate, but if you were just to think about the reversal of that impact alone on the value of the stock, can you give us some parameters to think about?
Yeah, so
It's in the slide on the penetration amongst younger users, because I think that's probably part of this.
yes. So starting with the COVID impact to this business, U.S. recovered very, very rapidly in terms of online dating, but emerging markets did not. And that you're seeing in APAC, which has been the highest growing geography that had a steep drop off from Delta and Omicron. That was a dramatic impact to the business. So starting just with quantifying the impact of how that can recover, the fastest growing segments became the slowest growing segments during these lockdowns, as they were a lot more extreme in the emerging markets. I think the U.S. recovered and bounced back a little bit faster. So that's where I would start there. And then in terms of the, are you talking about the age penetration and how that impacts COVID? Is that his follow-up to that question?
I think it was the average age and how we should think about that.
You have a slide in the pitch book that was sent to us that shows the penetration rate amongst different age groups.
This one here?
No.
This one? Yeah.
Let's see. I can't see it. Sorry.
That's okay. Yeah.
It shows, so the U.S. population, and it shows that male population, MAU percent penetration is going down.
Yeah.
Same thing for 18 to 30-year-olds.
Yeah, well, I mean, I would say just in general, MAU penetration went down in general in 2021 because of COVID. So I think that's the point you're making here, is that it's been broad-based. U.S. mobility has recovered faster, so U.S. revenue growth was a lot stronger. But just in general, when if I look at even just turning to the MAU chart for Tinder, to further answer his question, this blue line here is the MAU chart, and during 2021, you can see that while this has been plateauing, and during 2020, it started to dip down a little bit. So you are seeing a lot less users. People are not necessarily comfortable going and meeting a stranger at a bar for dating. So when I think about the impact, and even looking at preliminary January data and February data, there has been a bit of a recovery, and MAUs in the U.S., which has been a higher mobility from COVID market, the user numbers are just down. People are still paying because they want higher quality interactions. So the U.S. revenue is not impacted as much. But really, here in the U.S., you have this relatively steep decline. India, you have a decline. Going back to one more slide I wanted to show you. This is Pears, which shows a really, really dramatic decline in downloads and a plateau in an app that was growing 40% per year. So it really is a user base that's kind of flat from COVID, and as that returns to growth again, you should see continued strength, and people are still buying and paying for this.
I'll just point out that it started going down in 2019.
Yeah, so for Tinder, I want to be clear that it was already plateauing, but it took the year-over-year growth rates accelerated. The year-over-year declines accelerated in 2020 and 2021. Again, why 2019 I'm not worried about is because of how impactful downloads are for this app in the U.S. That's the key metric, is downloads, not MAUs, for a market that's pretty mature, which is the U.S. But yeah.
Just real quickly, so it's a 30 billion EV, and you have about $1 billion this year in free cash flow.
Yes.
30 times today. That's our entry. So really, your variant is they're going to generate more cash flow than is expected.
Yes. Absolutely. This is a cash flow story. Yeah, I think just to touch on that.
But your multiple in your terminal year is also 30.
Yeah.
So
why should that be?
Right.
So in 2022, it is trading at, so first of all, my 2022 free cash flow is higher because I'm assuming a recovery from COVID, which is not in street estimates. So let's just maybe start there and say that if you look at it from a street basis, but I believe that this business this is a duration play where I have larger than expected growth from Pears and Hinge, and Tinder sustaining duration at a 20% growth rate. So there's no reason why the multiple should contract meaningfully if they hit my free cash flow numbers. I think it's very reasonable. However, if you want to argue and say maybe it does contract a turn a year at 25 times, it's still a high teens IRR. But I would counter and say if Hinge outperforms, this should be an accelerating and an expanding multiple. So I think there's two sides of the coin you can play to that.
We have a reception downstairs on the second floor in the alumni suite. The judges were going to deliberate, and then we'll come downstairs and announce the winners. So you guys go ahead and start drinking, and we'll catch up.